Welcome to the Wealth Studying Podcast. This is episode 506. Today is January 9th, 2026. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, today got a quick episode for you. I received a lot of questions about, should you be running out and buying the oil companies right now, or maybe the oil service companies, the drill baby drill. This is all in light of what's happened with Venezuela. I briefly mentioned that in the previous episode. We'll get to all that in a minute. Let me just go back to the previous episode because I did get some comments about that, wanted to do an addendum. Some people reached out and said, hey, when you talked about the dump side of the economy, why didn't you mention civil disobedience and rent-a-mobs and all that type of opposition? Well, just didn't want to state the obvious. In any case, to that point, as a follow-up to the last episode in terms of the pump and the happy talk, you're seeing that, first thing out of the chute this year. What were Trump's big announcements other than the Venezuela issue? Well, it was all about things that are pumping up the economy and are going to inject a lot of capital and liquidity into both the stock market and the economy starting right now. If you'll notice, he proposed a ban on institutional investors owning individual homes or housing. That's designed to try and make housing more affordable. And paralleling with that, he's directed the federal agencies, I'm assuming the Treasury is going to do this, but we'll see. But he directed them to start purchasing $200 billion of mortgage-backed securities. This is what, of course, the Federal Reserve did back during the Great Financial Crisis. Again, that's designed to increase affordability of home ownership, mostly along the lines of, trying to reduce interest rates. And then finally, I didn't hear this from Trump, but I heard it from several of his minions talking about file your taxes early, which, number one, gets more money into the coffers of the government quicker, which helps with the deficit, which they are touting. The most recent calendar year of deficit, I think, have been one of the lowest ones since 2009. But in any case, why file your taxes early? Because supposedly we're going to see the most historic and largest tax returns in history. Now, again, this is not new news, but it is going to inject a lot of money into the economy, sort of like mailing out those checks during the pandemic. And the reason for this is that when they passed the big, beautiful bill over the summer, remember, they had a lot of tax breaks in there for the big fat cats, but also for the, quote, working man. So, overtime wages for certain employees, tips, things of that nature. You heard me before mention, for the business owners, the R&D tax credits, the 100% depreciation, the advanced depreciation, all that was in the big, beautiful bill, and it was retroactive either to, basically either the first of the year or when Trump came into office. And especially with your hourly workers, they did not go in and change their withholdings. And so anybody that's going to qualify for the tax break on things like overtime or tips, that's all going to be reflected in their tax return, which again is supposedly going to be the largest in history. So a big manna from the government heaven should allow a lot of consumer spending here in first quarter. Now, as far as Venezuela and drill baby drill, a lot of questions have come in saying, should you run out and buy ExxonMobil or Chevron, or more importantly, and yet overlooked, the oil services companies? Well, not necessarily. I'm not someone that believes in chasing the headlines, but I generally own a lot, if not most of those companies already. The oil companies I own going back at least to the pandemic, if not before. As far as oil service companies, they've been neglected and underappreciated for a long time. If you go back almost a year to the day, go back to my post on investablewealth.com at the blogs and update section, January 6th, 2025. I posted some 65 stocks I bought that day. 2 of them were oil services companies. That's Baker Hughes and SLB. And so, should you run out and buy them today? No, but a year ago was a pretty good time to buy them. And back then when I did, I didn't anticipate the invasion or whatever you want to call it of Venezuela. But what I did anticipate was the near 30 years, or at least certainly a generation of neglect that major oil fields, major heavy crude oil fields have experienced over these last, certainly since the 90s. And this is whether it's in Russia or Ukraine, parts of the North Atlantic, certainly Venezuela. These were all, sort of like a demographic trend of aging infrastructure that is either going to need totally refurbished or at least major upgrades. Companies like Baker Hughes, SLB, which are in my portfolio, I thought they would benefit from that. I did buy them. Halliburton's another one. For whatever reason, I don't remember why I didn't purchase it at the time, but I do own those other two. And yeah, I wouldn't run out and buy them today necessarily. But the interesting thing is you didn't have to buy them when I did back last January. In fact, the better time to buy them would have been over the summer. And this is sort of how we see these trends play out, that the smart money knew that probably an invasion or some kind of movement into these oil fields, whether it be Venezuela, Ukraine, parts of Russia, the smart money is betting that these things were going to take place because, pull up a chart, look at Baker Hughes, look at SLB. Over the last 6 months, I think both of those are up more than 20%, maybe 25% or more. Okay, that just didn't happen in a vacuum. Money flowed into those because the smart money was anticipating that there was going to be drill, baby, drill. And likewise, I held on to them. I have no intentions of selling them now. That's another point. I bought these stocks last January, Liberation Day. They crashed. I think they fell much harder than the overall market. I didn't run out in a panic. I didn't sell them. I held on to them. I bided my time, and they're doing just great right now. I'll tell you, if I was going to run out and buy a stock based on the headlines, it would most likely be another one that's in my portfolio, one that's been in there, again, it probably, I think it was during the pandemic, if not earlier, that I had at least some of it, but I think I certainly doubled down during the 2020 COVID-19 portfolio, and that's Valero. If you have those gas stations in the area, you know what they are. They're a refiner. They're going to really benefit from any oil that does come out of Venezuela. And as I mentioned in the last episode too, this is a power play. It's having the right cards or being able to put more chips on the table, bargaining chips for when we go into the NAFTA or the USMCA, I guess they call it now. But the negotiations that are starting this year as we relook at NAFTA and trade with Canada and Mexico, which, for the last 20 years has been primarily where we've gotten this heavy crude from. Even if nothing comes out of Venezuela, it's a bargaining chip to get a better deal on that oil. And so a refiner that uses that product, like Valero, I think is going to be a beneficiary. They already have been. Again, if you look at them over just the last year, I think they're up close to 50%. That's one of those classic contrarian plays where it's a very unloved stock because not the smart money, but the institutional herd mentality is that suddenly no one's going to use gasoline anymore. And that's certainly not true. Hey, bottom line, the long-term mantra of the Wealth Studying Podcast, ignore the headlines. It's all noise and static. To the extent it's useful, you use it as a contrarian indicator. Imagine you're watching a magician, and when the mainstream media is showing you something with their left hand, you want to be watching the right hand because that's where the real action is. And bottom line, there are long-term trends in place, whether they be demographic, geopolitical, automation, robotics, digitization, electrification. All these trends are in place for various different reasons, and to the extent that they converge and merge, those are the companies and the stocks that I want to be invested in. I remain fully invested. I'm accumulating money, just through normal savings. I plan to buy any dips along the way. And while I can't predict the future, I am pretty darn sure that, in particular, this convergence of technology is meshing up with the electrification and the digitization of the economy, which is really just a 60-year trend anyways. But you throw in the fact of declining demographics, that takes us into the economic Cold War that we're in and that we've been in for, well, I would say the last 20 years, but most people I think would recognize at least through the last 5 or 6 years. But either way, no matter how you slice and dice it, the geopolitical shift is causing countries all around the world to form new alliances. And for the United States and North America in general, that means industrial policy is bringing more manufacturing and more supply chains either closer to home or within friendlier nations. And that's why I want to own the full nuts and bolts of the economy. And sure, it includes the hyperscalers and the semiconductor companies. But beyond that, right, it's the railroads, the copper mines, the electrical sensors and monitors, the HVAC systems. Now, I haven't said it yet this year or maybe even in most recent podcasts, but you've heard me say it time and time again. We are living in the most prosperous economy in the history of humanity. So go out and take advantage of it, make it happen. It's within your reach. I'm certainly making the most of it for myself. And so I'd encourage you to come back and listen to future episodes. Until then, as always, this is John Pugliano wishing you the very best returns.